Two things not happening today. One, I'm not here to sell you anything. And two, in the Q&A, I'm limited with what I can say. I can't provide personal financial advice in a group setting like this one. And because of that, your participation today, it entitles you to a free consult with me, and I'll tell you how that works later on. Here's what we'll be covering today. And I must admit, taxes are not a fun-filled topic, and we'll do our best to keep you engaged. And I've got some real-life stories of families that we've worked with. My firm, Turning Point Financial, we're a registered investment advisor. We're regulated and supervised by the SEC. Our home office is in Frederick, Maryland, and we work with federal employees and clients from most agencies across the entire country. We're fiduciaries. That means we put your best interests first. And we get asked that a lot because it's important. If you're looking for an advisor, this is a question to ask. And that's because not every advisor out there is a fiduciary and held to the fiduciary standard. Our website is tpfinancial.com. I'll have that in a slide later on. You can learn more about us there as well. So why do we all need a long-term tax strategy? The obvious answer is you're going to pay more in taxes without a long-term tax strategy. Perhaps not this year or next, but it'll likely cost you a lot more over the long term. There are little things that you can do today, this year, and beyond to lower that long-term tax bill. Participating in the Roth, it's just one example. And I'll show you some ways and I'll share some stories. I'd like everyone to think outside the box for just a sec, and not just what your family earns in a year and the taxes you pay in a year, but think about the total of all those taxes during your entire working career. It's scary because it's hundreds of thousands of dollars and maybe more. What if you could chip away at it, put some dents in it, lower that big tax bill by $50, $100, $200,000 and have that for your fun retirement money? Getting advice from a financial planner or tax advisor, it can and does save the kind of money that I refer to. I see it all the time. But for it to work and to maximize the impact, it needs to be done well ahead of retirement. You simply cannot start on this sort of thing too early. For most people, if you do nothing and keep doing what most people are doing today, you're going to end up with what we call the government plan, which is paying taxes for the rest of your life at whatever rates they tell you. You have a choice. You can make your own plan by acting today and actually creating tax-free sources of income. The Roth, that's one of the ways to do this. And that can be your Roth TSP, your Roth IRA. Some of you have spouses and partners that are in the private sector. They might have a 401k or a 403b with Roth options. The choice is yours. You can take their plan and adapt as tax laws change, or you can make your own plan. If you're making your own plan, I'd suggest working with someone who knows what they're doing. Long-term tax planning, it involves understanding all of your sources of income during retirement. That's going to be your pension, your Social Security, RMDs, Roths, part-time income, some have rental income, and then your spouse or partner, what do they have going on? A portion of each of these, it's taxable. And the impact, it is something that you need to know about. It can be complicated. We all agree it's okay to pay our fair share, but no one wants to leave the IRS a tip. Creating a financial plan early on and getting in front of the tax obligation, that's one way to make your own plan. Roths, they remove the uncertainty of future tax rates because Roths are funded with after-tax money. And let me just touch on after-tax rates for future tax rates for a moment, which are being talked about under the current administration. I'm not going to talk a lot about that today because what's being bantered about, what's being suggested or proposed, it's noise. And in our view, something may happen next year. So to get too wrapped up into what's being talked about now, I find it to be it's a waste of time and energy. The Roth is a way to deal with that uncertainty, and we're going to talk a lot about that today. So here's some head spinning things. Some of this stuff you might be familiar with. This is why it's so complicated. Just look at some of the things here on this slide. I mean, what is all this stuff? I'm sure some of it may look familiar. We're not going to get into this because it's boring. And some of it's important. Estate tax thresholds, they changed with the last administration, and those numbers, they're set to expire in 2025. A story I like to tell related to taxes is with the head of our planning department, John. His daughter is getting married this year, and John and his wife would like to help pay for some of their wedding expenses. John planned for this. John has some stock that he plans to sell to help pay for the wedding. But when John sells that stock, there's a capital gains tax. And he's held it a long time, so it's probably pretty hefty. The strategy that John came up with was to gift that stock to his daughter. She'll sell the stock, she'll have the tax burden. So we're taking the tax burden, tax obligation, the capital gains tax, moving it from John and his wife to the daughter. It gets better. The daughter will sell the stock. The daughter makes less money than John. The daughter is below a threshold where she won't have any capital gains tax. She can sell that stock and realize the full benefit of its value without having to pay any taxes. Pretty cool, pretty unique story. Not a lot of people are aware you can do things like that. That's going to benefit their family a lot. Got another slide with a bunch of things on it. I'm going to talk about autopilot, which is what most of you do with your TSP right now, and probably some other deductions. Have things come out automatically each pay period. What I'm talking about is, yes, the TSP, but there's also FSA, flexible spending account, HSA, health savings account. If you have these things set on autopilot, you can possibly lower your current taxable income. The HSA or health savings account, if you have one of those, you might consider building that up, using that in retirement to pay for a variety of medical expenses. Think of it as a Roth IRA for medical expenses, only it's better than the Roth because it's triple tax-free. It's a no-brainer. Money goes in pre-tax, it grows tax-free, it comes out tax-free as long as it's used for medical. And it gets even better. The money, it can be invested. So if you're young, an HSA, that's probably the absolute best thing you can do. Different types of accounts offer different strategies, and this goes along with what I showed you earlier, tax efficient withdrawals. If you have options to take money from accounts that offer different tax rates, you truly have your own plan and not the government plan. That's where we all should strive to be. The types of accounts that I'm referring to are the Roth and traditional IRAs, plain vanilla investment accounts, whether they're individual or joint, 529s, college savings accounts, HSA, FSA, and bank accounts. The IRS, how do we handle that? So I've been a do-it-yourselfer off and on over the years. I get it. I like TurboTax. I think it's gotten much more user-friendly each year. At Turning Point, we have our own tax department. We created that about 2 years ago. And I'm continually amazed at how our CPA is constantly finding mistakes in the tax returns that he reviews. And it's not just from do-it-yourselfers, but professional tax preparers, they make mistakes. TurboTax, in my opinion, while I like it, it can be manipulated. Some of you might know that. It works with what you tell it. It is not proactive. It cannot do the type of tax planning that we're talking about here today. And I'm not trying to sell you on our tax services, but just open your eyes to the things that we encounter all the time. Working with someone that you can trust, someone who proactively gives you advice, that's where we all should be. When we're doing financial planning for our clients, I'm constantly pushing for ideas and recommendations from the tax department to improve a family's financial situation and address that massive long-term tax bill. Hang with me a sec on this. I've got a good example for you. If an individual makes $100,000 a year, just a hypothetical amount, they pay $25,000 a year in taxes. Just made up numbers. Make 100, 25 a year in taxes. They work for 30 years. That's $750,000 in taxes. What if we could reduce that to 650 or 600? That's serious money saved. That could be invested along the way to provide for an early retirement or certainly a more comfortable retirement. Audits, red flags, everyone should know the IRS, they never call. They notify by mail. I'd say get help if you don't understand your audit. Red flags, they're unique to each family. Look at what we have here. Missing out on these sort of deductions, these are the things, it goes back to what I said before. I'm okay paying my fair share, but I don't want to leave the IRS a tip. If I miss one of these, I'm leaving a tip. Number one, it's big. This applies to folks that own mutual funds and stocks and have their dividends reinvested. When they go to sell those stocks, oftentimes they forget to add back in all the dividends they received over the years. You add those back into your cost basis, raising your cost basis. If you don't do that, you end up with a double tax because you paid taxes on the dividends when they were distributed, and you're paying tax on the sale of the investment. If you do charity work, there's a mileage allowance for driving to and from where you perform your service. Medical is big. Medical receipts, that's a possible deduction. If you have high medical expenses and those exceed a certain percentage of your adjusted gross income, that could be deductible. Keep the medical receipts. One of our clients, they were making major mistakes in their tax life, despite having their taxes done by someone else. As I said before, mistakes are common, and unsolicited advice from CPAs, that's uncommon. Always ask the tax preparer for ideas and suggestions. Many are simply not forthcoming. It's just the way they are. Some examples of what we uncovered for our client: they were not taking advantage of deductions on medical expenses, including mileage. This client, 3 kids, they're doing well saving for college, but they're not doing it the right way. And they're missing out on their state's generous state tax deduction. Happens to be New York State, which provides a $10,000 tax benefit with its college savings programs. Client had a Roth, but they weren't fully utilizing it. We suggested setting up another for their spouse and making annual contributions. The family also had somebody that's considered special needs, did not have an ABLE account, thereby missing out on its tax benefits. Lastly, with the tax strategies that we recommended for the long term, which included Roth conversions, that will save our clients several $100,000 in our estimation over their lifetime taxes. I point this out because I believe each of us needs to take a very close look at our personal circumstances. The question to ask is, am I overpaying the IRS? Hang with me, folks. I know this is a lot. It's definitely worthwhile. We're going to get into the Roth now. The Roth, it's one way to incorporate a strategy to manage the uncertainty of what future taxes might look like. Mentioned that earlier. Everyone on the call today, everyone on the call today should have some of their retirement money invested in the Roth. That's going to be your Roth TSP or Roth IRA. And by the way, everyone can participate in a Roth IRA regardless of your income. If you believe or you've been told that you make too much money to have a Roth IRA, you're misinformed. There's a little used strategy called the backdoor Roth that allows high wage earners to have Roth IRAs. Let me know if you'd like to know more about that. I just want to pause for a second here, make sure everyone is understanding what I'm saying. What we're suggesting is a Roth IRA, which you do on your own or with someone like me, or Roth participation in the TSP. Some people do both. If you can do both, that's a good idea. The Roth, it's funded with money that's already taxed. It grows completely tax-free. It then comes out tax-free. When you need money in the future, you can use the Roth without having to pay extra taxes. Think about it. If the tax rate's higher in the future, and many people believe it will be, you'll be in a great position to have access to tax-free money. That's the Roth. Anyone with a TSP, a 401k, a 403b, you need a tax solution. And taking advantage of today's tax rates on sale is the way to be thinking about Roths. Roth conversions, that's something I do every year as part of my long-term tax strategy because it allows me to lock in today's low tax rates. You're paying taxes once and never again. Having a Roth, that removes the uncertainty of future tax rates. Best of all, they're invisible on your tax return. The Roth conversion, that's simply converting or moving money from a traditional IRA to a Roth IRA and paying taxes on the amount converted. You pay those taxes when you file. If you or your spouse or partner have old 401ks, 403bs, or IRAs, you can use them to jumpstart the Roth. Just to repeat, it involves paying taxes now in exchange for not having to pay tax on distributions later, like during retirement. What do you estimate the future tax bill on your RMDs if you do not convert? I convert a small amount each year because the tax bill on converting the entire thing, it's too much. This is my plan, and I want my plan, not the government plan, which is RMDs. RMDs are required minimum distributions. Those start at age 72 for any traditional retirement plan, like your TSP. We call this the government plan because it forces you to start taking a certain amount out each year, beginning at age 72, whether you need the money or not. This is how taxes are collected. Those RMDs, they're taxed at ordinary income tax rates. Roths, they don't have RMDs because you already paid the taxes up front. You never have to take the money out of the Roth. Some folks use it for estate planning purposes. They'll have a Roth and that money is intended to pass on to their kids. Here's a crafty little strategy for retired folks taking those required minimum distributions. Here we use life insurance as a strategy to get tax-free money to our loved ones. If that's important to you, then using life insurance is a great way to do it. Life insurance death benefits, they're tax-free to the beneficiaries. In our example, this person's obviously financially sound. They have a little extra cash each month. We take that little extra and we pay life insurance premiums with it. If you're charitably inclined and you want to leave money to your favorite charity, those premiums, they could be tax deductible. The charity gets a tax-free benefit when you pass. Obviously, this isn't for anyone, but for folks who want to leave a legacy, it can certainly be worth exploring. Turning Point, I didn't mention early on, we're a financial planning firm. I'm admittedly biased, but I must say, I believe everyone needs a financial plan. That's regardless of your age, your net worth, your stage in life, or where you're at in your career. If you don't have a plan, you only have a wish and no roadmap to achieving that wish, that goal, that dream, whatever. You may still get there, but it'll likely take a lot longer and be a lot more frustrating. A recent planning client of ours, they had a dream of retiring early, age 50. And I love, bold ambitions like that. They had been a good saver and investor their entire career, but they had too many accounts. They didn't know how their money was allocated. They weren't taking advantage of college savings plans that offered tax benefits. Too much money in a savings account that wasn't earning anything. No Roth participation, no long-term tax strategy. With our advice, solid direction, accountability, this client, he'll get to do everything he wants for his family. And in the process, he'll realize close to $1 million in savings with the strategies that we recommended. Had they waited until they were on the cusp of retirement to have a financial plan done, the cost of waiting, $1 million. Now, obviously, not everyone can reap savings this large because each of our circumstances are unique, but savings of some sort, it's possible for everyone. You won't know if you're ready to retire without knowing what you'll need in this new phase of your life. And it's never too early to start planning. And to do it right, you have to dig into the details. The process, it gives you clarity. You'll really know what to expect. Everything works together. What you make, what you spend, what you have, and what you need. Taxes, they're often ignored, and they can make a huge difference to your bottom line, as we've talked about here today. The biggest mistake we see people make, it's not asking for help when you really need it. Fortunately, you have resources. Several federal agencies, they've asked me to be a resource to you. Please reach out if you need help or you have questions about anything we talked about here today. My contact information is on the screen. Everything's completely confidential. You can learn more about me and my firm on our website, tpfinancial.com. I'm also on LinkedIn. Early on, I mentioned a free consult. If you're interested in that, I'll be sending each of you an email with a link to schedule a meeting if that's something you're interested in. That's 20, 30 minutes. We can talk about this content or anything else that's on your mind that's related to your personal finances. Along with that, I'm also going to send and include our financial scorecard. It's a freebie. It's 10 questions online. It'll give you an idea of the types of things you need to be thinking about in your financial life, whether it's cash flow and budgeting or estate planning, investments, retirement, all that stuff. We've got these different categories. It'll give you a sense of the most important things to think about and just how organized you might be or might not be. So we could talk about that in a meeting if you choose to do so. Let's get to some questions. If you have questions, you can pop those in the Q&A. Again, feel free to email me if you prefer to do that.
Got some questions in the chat, actually.
Thank you. Yep. So there's two ways to do questions. There's Q&A and there's chat. Any tips on electing the TSP Roth? Yes. So as I said, everybody should have a portion of their money in the TSP Roth. You want to have different tax strategies for the future. Tax laws are written in pencil. They change all the time. We don't know what's going to happen. Yeah, people say taxes are going to be higher in the future because we've got all this debt we have to pay for, but nobody knows for certain. So having traditional Roth, traditional TSP, it's a good idea. Having both, having multiple levers you can pull. The Roth comes out tax-free. I was talking to somebody yesterday who has a Roth and a traditional IRA, and he's retired, and we talked about letting that Roth grow. And if tax rates are higher in the future and he needs a source of tax-free income, he can pull that Roth lever and take it out of it without having to pay taxes. I hope that helps answer it. So I suggest both. One thing to know with your TSP, as with any employer-sponsored retirement plan, the match that you receive, the 5% match, it does not go to the Roth. By law, it cannot. You still get it. It goes to traditional. So if you're contributing 5% to your TSP, to the TSP Roth, 5% goes to TSP Roth. The other 5% will go TSP traditional. So keep that in mind. Another question, are Roth conversions possible in the TSP? No, they're not. So, and it's not just the TSP. It would be a 401k, a 403b, any employer retirement plan. You can't do conversions there. You got to take it out, and it's done in an IRA. Somebody's asking about a video available. Yes, we will share that. I'll get that to Tracy. She'll distribute that later in the week or early next week. Thank you for being here. We'll also share the slides. Those are coming your way too. So.
And I see there are now 2 questions in your Q&A.
Thank you. What are the dangers of joint accounts referenced in your slide? Good question. You have to sort of take a step back and think about, so I like to say, or in planning, we say, what's the money for? You know, we're doing all this savings all our life, and we've got money in a TSP, and we've got money at Charles Schwab, and we've got money in an IRA, and money at the bank, and some are joint accounts and other types of accounts. So what's the money for? Who's it for? What does your estate plan look like? What are your intentions? So that sort of that needs to be solid as well. That speaks to this as to what types of accounts you have and why you have those kind of accounts. In a joint account, when something happens to you, the money, and there's different kinds of joint accounts. There's joint tenants with rights of survivorship. There's joint tenants in common. And depending upon how it's set up and the state you live in, that money can go different places. So let's use a couple of examples. This is a really good question. So a typical joint account, I have a joint account with my wife. Something happens to me, everything automatically goes to her. It's nice, it's easy, it's convenient. She can go to the bank with my death certificate and set up an individual account and have everything set up in her name. That's joint tenants' rights of survivorship. Tenants in common, which some people will use for estate planning purposes. My wife and I have a joint account, tenants in common. I pass. My half of the money, she gets half. The other half goes to my estate. That might be my kids. That might be something different I have spelled out in my will. Again, what are your intentions? What's the money for? Who gets it? Titling, which is what this is called, titling of accounts is really important. So good question, definitely worth asking, definitely worth talking about in your estate planning session with your estate attorney. 3 documents everybody needs: a will, a power of attorney, and a medical directive. Those are 3 documents we all need related to estate planning in its simplest form. Moving along to some other questions. When do we get our 2020 refund when filing submitted by paper on March 7th, 2020? How much to wait? I'm sorry, I don't know the answer to that. I would suggest following up with the IRS. They have an automated number you can call. You put in your social security number, and they can usually tell you, give you an idea of when you might get that. Sorry, I can't be more help there. If we're working beyond age 72, is the RMD necessary? Another good question. If we're working beyond age 72. If you're still working beyond age 72, you can continue to contribute to the TSP or the 401k. The RMDs don't apply. The required minimum distributions don't apply if you're still working. Now, let me take that a step further. So I'm assuming when I say still working, you're still doing the job you're doing today. You're with the FCC today, and you're with the FCC at age 73. You don't have to take those RMDs. If you're doing part-time work at the drugstore, at Home Depot or something like that, then the RMD would apply. You're going to have to take it out. Any other questions, folks? You can put those in Q&A or the chat. Feel free to email me. As I said, I'll shoot you all an email with a link to schedule a meeting if you'd like to schedule a free meeting with me. And I'll have another link to our financial scorecard. We'll, I'll work with Tracy in the future. If you guys are interested in having more of these in the future, you have a particular topic in mind you'd like to hear about, let her know or let me know. I've been working with other federal agencies doing this for some time now, and we have quite a library of topics, and Tracy will help coordinate that if that's something you're interested in. And again, she mentioned early on, I'm always interested in feedback, whether you liked it, didn't like it, what you liked about it, and ideas for future workshops like this. When you get the recording, if you'd like to share that with a friend or a family member, you're welcome to do that. Don't have a problem with that. I'm in the process of trying to create a video library on our website so people can just go there and watch what we've have recorded on at their convenience.
Bert, thanks so much. I really appreciated the presentation, and I look forward to talking to you about our next topic. So
wonderful. Well,
so
thank
much.
you, and Thanks to everybody for being here today. Appreciate you signing up. And if I can help in any way, please reach out.
And members, thanks so much for your attendance. As Kurt said, we're very interested in your input regarding this particular seminar. If you have an interest in any others, let us know how we can assist you. Happy you're here. We'll send around the slides as well as the video to those who are interested or want to look at it again. So have a great afternoon. Kurt, thanks so much. I'll be back in touch.
All righty. Thank you,
Okay.
Tracy.
All right.